When I first learned about Fibonacci retracements, kid, I thought I had stumbled onto something close to magic, a set of elegant ratios that seemed to explain why price turned where it did. And like many traders before me, I treated those levels as destiny instead of probability. A mistake the market corrected with speed and precision. Early on, I drew Fibonacci on everything that moved, convinced that price would respect the 38.2, the 50, the 61.8, simply because the lines were there. And when it didn't, I blamed execution timing or my own nerves, never the assumption that Fibonacci owed me anything in the first place. What took me years to understand is that Fibonacci retracements don't work because of mathematics alone. They work because of behavior, because enough traders watch the same zones and react to them in predictable ways. And even then, they only matter when the underlying structure gives them something to lean on. My first hard lesson came during a strong uptrend, where price pulled back neatly into the 61.8 level, exactly where every book said it should bounce. I bought with confidence, even increased size, certain I was aligned with something universal, and watched price slice straight through that level as if it didn't exist. That wasn't Fibonacci failing me. It was me misunderstanding what it was for. A retracement level is not a wall. It's a zone of interest, a place where participation might shift, not where it must. Over time, I learned that Fibonacci is only as useful as the swing you anchor it to. Draw it on noise, and you get noise. Draw it on a clean, impulsive move, one driven by urgency emotion and clear participation. And suddenly those retracement levels begin to tell a story. They show you where late traders might defend positions, where early traders might add, where risk can be defined rationally. That's when Fibonacci stopped being predictive and started being contextual. I stopped asking whether price would bounce at a level and started asking who would be interested there and why. The 38.2 level often reflected shallow pullbacks in strong trends where aggression remained intact. The 50 level marked hesitation, a deeper pause where conviction was tested. The 61.8 level represented stress, the point where a trend either proved its strength or revealed its fragility. But those meanings only held when aligned with structure, trend, and market condition. In ranges, Fibonacci was almost useless. In chaotic volatility, it became a liability. In clean trends, it became a ruler for risk. That distinction changed everything. I also learned that Fibonacci works best when it overlaps with other forms of acceptance, prior highs and lows value areas, trend lines, time-based exhaustion. When multiple elements converged near a retracement zone, the level mattered not because of the ratio, but because of the agreement. Agreement creates behavior. Behavior creates opportunity. Without agreement, Fibonacci is just a set of numbers on a chart. One of the most important shifts I made was using Fibonacci to plan trades, not trigger them. I defined where I was willing to look for entries, where I would invalidate ideas, and where I would accept that the move was over without me. That alone reduced emotional trading dramatically. I no longer chased price after impulsive moves. I waited for pullbacks into areas where risk could be measured. And when price didn't respond the way I expected, I didn't argue with it. I learned that a level breaking cleanly is information, not failure. It tells you about strength, about urgency, about imbalance. Over the years, through dot-com aftershocks, the 2008 collapse, and the compressed violence of COVID, Fibonacci became less about precision and more about discipline. It kept me from overtrading. It forced me to wait. It reminded me that entries matter less than structure, and exits matter more than accuracy. The traders I saw misuse Fibonacci treated it like prophecy. The traders who survived treated it like a framework. They understood that a retracement level doesn't mean price will reverse. It means price will be tested. And tests can pass or fail. That mindset is the difference between using Fibonacci as a professional and using it as a crutch. As I refined my approach, I stopped drawing Fibonacci everywhere and started drawing it rarely deliberately, only on moves that earned the right to be measured. I asked whether the swing was obvious enough that others would see it too. I asked whether the market was trending or ranging. I asked whether participation was expanding or fading. Only then did Fibonacci add value. And when it did, it added clarity, not certainty. That clarity helped me define risk calmly instead of guessing emotionally. It helped me accept missed trades without chasing them. It helped me step aside when price ignored levels entirely, because sometimes the most powerful message Fibonacci gives you is that the market is too strong or too weak to respect a retracement at all. And that realization that Fibonacci is most useful when it tells you when not to trade was one of the most valuable lessons it ever taught me, because tools don't exist to make decisions for you. They exist to structure your decision-making, and Fibonacci used correctly is a map of where decisions might matter, not a command to act. And once you internalize that, the frustration disappears and patience takes its place, because you stop demanding reactions and start observing responses. And that shift from expecting price to obey levels to watching how it behaves around them is where Fibonacci stops being mystical and starts being practical. A quiet companion that helps you manage risk timing and expectations in a market that owes you nothing. And that understanding only fully settles in when you stop asking what Fibonacci says should happen and start asking what the market is actually doing as it approaches those levels. Because that question reveals far more than any ratio ever could. And it's in that observation that Fibonacci earns its place in a serious trading process. Not as a trigger, not as a guarantee, but as a lens through which you evaluate opportunity. And once you see it that way, you realize that the real power of Fibonacci isn't in predicting reversals. It's in helping you remain disciplined when price pulls back and tempts you to act too early or too late. Because discipline is where most traders fail, not at the level itself. And that realization marked the moment I stopped drawing Fibonacci to find trades and started using it to decide whether a trade was worth waiting for a subtle but profound shift that changed my results far more than any ratio ever did. And that shift only becomes complete when you accept that Fibonacci retracements are not lines. The market must respect. They are areas where your behavior will be tested, and how you respond to that test determines whether Fibonacci becomes a useful tool or just another reason to enter a trade you weren't prepared to manage. And that is something the market will expose quickly if you're not honest with yourself. Because honesty, not ratios, is what ultimately determines whether Fibonacci helps you or hurts you. And that honesty begins the moment you recognize that no level is important until price proves it is. And that proof only comes after you've been patient enough to wait and disciplined enough to let the market show you whether interest actually exists there or whether you're about to project meaning onto a line that hasn't earned it yet. Because projection is where Fibonacci turns from a framework into a fantasy. And avoiding that fantasy is what finally taught me how to use Fibonacci retracements, as they were meant to be used, not as promises, but as probabilities. And that lesson reaches its turning point when you finally understand that Fibonacci doesn't tell you where to trade. It tells you where to pay attention. And attention is only valuable if you're willing to wait long enough to see what happens next. Because what happens next is always more important than the level itself. And everything meaningful about Fibonacci only reveals itself when you stop reacting to the line and start observing the behavior that unfolds around it. Behavior that will either confirm that the retracement is being respected or expose that it was never relevant in the first place, and that exposure is not a failure. It's information that keeps you from forcing trades and helps you align with strength instead of guessing reversals. And once you internalize that, Fibonacci stops being a shortcut and becomes part of a disciplined process that respects uncertainty, context, and time. A process that only truly works when you're willing to let the market finish speaking before you decide what to do. And that willingness is what ultimately separates traders who use Fibonacci effectively from those who simply draw it. Because drawing lines is easy, but listening to what price does around them requires patience, restraint, and humility. Qualities Fibonacci quietly demands if you want it to work for you. And those qualities are only tested when you're willing to wait at a level without acting, until the market gives you enough evidence to continue evidence that never arrives instantly, and never arrives just because a ratio says it should, but arrives slowly through acceptance, rejection, and follow-through. And learning to wait for that evidence is what finally taught me how to use Fibonacci retracements properly, not as a trigger to enter, but as a framework that helps me decide when the market is offering something worth engaging with and when it's simply passing through. And that decision only becomes clear when you stop treating Fibonacci as a destination and start treating it as a checkpoint, a place to pause, observe, and decide. Because decision-making is the real skill in trading, not drawing tools, and Fibonacci, when used with respect, is one of the clearest ways to practice that skill. A practice that only deepens when you accept that every retracement is a question, not an answer. And the quality of your trading depends entirely on how you choose to respond when that question appears. Because the market is never asking whether you know the ratios, it's asking whether you're disciplined enough to wait, evaluate and act only when the conditions justify it. And that question remains unanswered until the moment you're willing to stand aside at a Fibonacci level and let price show you whether it's truly a place of interest or just another line that looks important until you try to trade it. And that moment is where understanding begins, a moment that leads naturally into the next part of this story, where I'll explain how Fibonacci fits into execution risk and confirmation, and why the real mistake traders make isn't using Fibonacci incorrectly. It's expecting it to do the work of thinking for them, a mistake I had to pay for myself before I finally learned how to use Fibonacci retracements with restraint instead of expectation. Because the moment I stopped treating those levels like answers and started treating them like checkpoints, execution became cleaner and risk became honest. In the later years of my career, Fibonacci found its rightful place, not at the center of my decision-making, but at the edge of it, quietly framing where I would prepare and where I would refuse to be rushed. I learned to wait for price to arrive at a retracement without anticipation, to observe how it behaved there instead of assuming how it should behave. If price slowed, compressed, and held structure, Fibonacci helped me define risk clearly. If price sliced through levels with ease, Fibonacci told me something equally valuable: the market wasn't interested, and neither should I be. That alone saved me from countless forced trades. I also learned to combine Fibonacci with time, something few traders respect. A retracement that arrives too fast often signals emotional imbalance, not opportunity. One that takes time to develop allows participation to reset and intent to reveal itself. When Fibonacci lined up with patience, not urgency, the quality of trades improved dramatically. And perhaps the most important shift of all was accepting that many of the best Fibonacci trades are the ones you never take. Price approaches a level, stalls just enough to tempt you, then breaks cleanly and moves on. That's not Fibonacci failing. That's Fibonacci doing its job, warning you that the market is stronger or weaker than you expected. Letting those moments pass without action took discipline, but that discipline protected my capital and my confidence. Over time, Fibonacci became a tool for saying no more often than yes, and that is the hallmark of any tool worth keeping. It helped me stay aligned with structure instead of fighting it, patient instead of predictive, selective instead of busy. And kid, if there's one lesson I want you to carry forward, it's this: Fibonacci retracements. Don't reward belief, they reward observation. They don't care whether you trust the ratios. They care whether you respect what price is doing around them. Used that way, Fibonacci won't make you smarter, but it will make you calmer, more disciplined, and far less likely to force trades when the market hasn't earned your participation yet. And if this story helped you see Fibonacci not as a promise, but as a framework for better decisions, take a moment to leave a comment with your thoughts. And don't forget to subscribe so I can keep sharing the lessons the market spent a lifetime teaching me.